Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Wednesday, October the 7th, 2020. I have a very distinct honor and great pleasure of welcoming to the show a new guest who I've not spoken with before, and he is the CEO of a company called Gold Royalty, and he has one of the most impressive resumes that I've ever had the honor of reading, and of someone who that I've had never had the pleasure of speaking with this type of resume before. He has a 30-year career in mining. He has been the driver of a number of the largest global gold and copper producing companies, including Ignacio Eagle Mines, Hub Bay Minerals, most recently as CEO of Gold Corp, which was a top 3 global producer. His track record includes developing over a dozen projects into producing gold mines. As CEO of Gold Corp, David made history last year by spearheading the $32 billion merger of Gold Corp with Newmont to create the world's largest gold production company. Since that time, the value for Gold Corp shareholders tripled, including dividends. It turned out to be a brilliant move. Speaking of the CEO of Gold Royalty Corporation, Mr. David Garoflo. David, welcome to the Daily Coin.
Thanks for having me on, Rory.
David, I am so grateful to be speaking with you today. And I apologize, I'm a little bit nervous. As you are well aware, I've kind of been stammering around here for the past couple of minutes. And I think that it has to do with your stature in the community. It's a little bit, I've not spoken with someone of your stature before, and it's showing right now. And I'm a little bit starstruck, if you will. So I apologize for that, but I'm so honored to speak with you. There are no words to describe. But I wanted to get your take, David. Do you mind if I call you David?
Yeah, that's great. Thanks.
Or Dave? Do you prefer Dave?
Dave is my preference, but yeah, please.
Okay.
Yeah.
Dave, I wanted to get your take, first of all, on what you see happening with the Federal Reserve and their announcements recently about inflation, and where the Federal Reserve is trying to engineer everything, and what they have done over the past year. Really, they started last year with just flooding the market with all of this QE to infinity. We've been at we're negative real interest rates, but zero interest rate policy was introduced, and gold has responded in a way that it should have. And I wanted to get your take on what you see, where the gold market has been, where it's at currently, and what you see coming up, and what your analysis shows for 2021 and beyond.
Well, I think you hit the nail on the head, Rory, in terms of leading with the central banks and their recent posturing with regards to inflation. They've largely abandoned their inflation targets. You know, back in the day, you think back to when Paul Volcker was the chairman of the Federal Reserve, the focus was very much on controlling money supply and having monetary policy being driven by trying to achieve a certain band of inflation targeting. And that's been largely abandoned. Now the talk is about achieving full employment. They have half an eye on the equity markets and keeping that parade going. And really that's abandoned the fundamental principles of why central banks are around. And really the reason central banks, in particular the Federal Reserve, have pivoted is really a credit crisis we experienced 10 years ago, where the central banks actually started to coordinate their activities. and I'm talking to central banks across the industrialized world, and they made the decision that preserving credit markets, preserving employment, and preserving the upward trajectory in equity markets was much more important than inflation targeting. And the only way to do that was to introduce a lot of paper into the economy, the indiscriminate printing of fiat currency. And gold is a barometer of that. And so we saw gold react very violently 10 years ago to that. And it achieved at the time a high of about $1,900 an ounce, or a little over that. And more recently, and the COVID crisis has really accelerated this, they've gone back into that quantitative easing on a coordinated basis globally to try to preserve some economic activity. We were already experiencing anemic growth heading into the COVID crisis, and quantitative easing was already in the cards. And now it's just accelerated that and amplified it, if anything. And that's resulted in gold prices achieving new, at least nominal highs. We're not at cyclical highs yet. If you look at gold back in 1981, it was in the mid 800s in 1981 dollars. In today's dollars, that's about $3,000 an ounce. And so, and I mentioned that target or that price because Merrill Lynch has come out with a target for gold in the next 18 months of $3,000 an ounce. And I would suppose that they did not pull that out of their hat, that they looked at the previous cyclical high in real terms back in the early 1980s when we were experiencing hyperinflation or just coming out of a hyperinflationary cycle. And gold experienced at the time real all-time highs. So we're not even there yet. We're still 50% or so away from achieving the previous highs for gold in real dollar terms.
And I presume that you are watching the silver market as well, and as closely as you watch the gold market. And just so you're aware, Dave, back in December of 2017, I forecast gold and silver to both be exploding right now, beginning this year. Didn't foresee any of the coronavirus layered on top of everything. It was just the fundamentals just were pointing at this time frame. And I see gold going between 2021 and 2025 into those numbers, somewhere between 2,100 and 2,500 over the course of the next few months, next year really. And I see silver doing exactly the same thing. And one of the things that I didn't take into account in my forecast was the COMEX digital futures price versus the physical price of what you and your companies do, which is bring physical to the market. And is that part of what we have to, do you see a divergence in that at this point, or how do you see the futures market and the physical market kind of living together, or are they going to go their separate ways?
Well, let's talk about the physical market, because I think what's interesting is even as gold prices go up, we're not seeing any increases in reserves or production in an appreciable way. And that's because of a severe underinvestment and exploration in the industry over the last 10 years. So we exited the past credit crisis and saw gold prices achieve at the time all-time highs of over $1,900 an ounce a decade ago. But the gold companies actually experienced deteriorating profitability in the face of that because their costs were inflating dramatically. We were in the middle of the super cycle at the time, and all material prices were going through the roof. And so there was a rush to build new capacity in both base and precious metal, oil and gas. And so we're all competing for scarce resources. So we saw our margins deteriorate even as the gold prices were going up. So since then, the institutional investors have demanded of the gold industry that they focus on stabilizing their costs, not reinvest in exploration, in new capacity. And so as a result, we've actually seen reserves decline by about 50% across the industry, even in the face of a rising gold price environment. And reserves, these are reserves in the ground owned by established producers. Reserves are a leading indicator of where production's going. And so even with rising gold prices, we're seeing a scarcity of supply. And that's, if anything, exasperating the demand supply fundamentals, or strengthening them, if you will, if you're a gold bull. And I think will only serve to support the gold price going forward. And to your point on silver, I would say I'm even more bullish on silver because traditionally the relationship between gold and silver prices, historically the ratio in the bull market has been somewhere around 40-1, gold prices to silver prices. But today, even with silver up quite dramatically this year, is still about 70-1. So if you do believe in the gold price targets that have been put out there of $3,000 an ounce, then silver in a rising gold environment should be closer to $100 an ounce in that environment. So, it's a tripling or more of where we are today with silver. And so I think it has the potential to outperform gold, even as gold is expected and poised to have a very significant bull run.
I would agree with that wholeheartedly, and I think that that's exactly what we're going to see is silver outperforming gold, and I think that we are going to see. I'm sure you're familiar with Keith Neumeyer over at
Yep.
First Majestic. I mean, he's been calling for triple-digit silver for quite some time, and I think that is in the cards at this point. I mean, I personally have never said that before, but I feel confident in saying it today because the fundamentals are there. I mean, we're going to get into the mining industry here in just a minute, but as you're well aware, Dave, the mining industry has suffered for the past decade or more with low capitalization, low inflows of capital, and development, and now everything that whole thing is changing. As you put together the deal last year with Newmont and between Goldcorp and Newmont, I mean, that was, to me, that was a tale of what's actually happening. And I want to bring this to the fore real quick, and that is to congratulate you on the graduation, if you will, for gold mining and Gold Royalty, which is a company within gold mining at this point. We're going to be talking about that here in just a second. But gold mining is no longer part of the Toronto Ventures Exchange. It is now a full-fledged member of the New York Stock Exchange, trading under the symbol GLDG, and that's a pretty big deal. Or am I making too much of it?
No, I mean, to get on the big board is extremely important for liquidity in the stock. But I think more importantly, what's fundamentally changed is these development stage companies like gold mining are going to become that much more attractive in the face of declining reserves for the established producers. So the producers have kind of lost the art of building mines over the last decade, but they're going to have to refine that skill set because they are faced with depleting reserves and production profiles. And so we, within gold mining, have accumulated a portfolio of 14 development stage assets, collectively containing over 25 million ounces of gold reserves and resources. Just to give you some perspective on that, 25 million ounces of reserves and resources is enough to create a senior producer. Now, there are senior producers that have less reserves and resources in the ground than we have within gold mining. These are all admittedly development stage assets. And what we've been doing over the last decade within gold mining is effectively inventorying those ounces at the bottom of the cycle. Amir Adnani, the founder of gold mining, bought those 14 development stage assets on average at $2 to $3 per ounce. And so today it trades at about $14 to $15 per ounce. But typically development stage assets that have good economics could be trading in the hundreds of dollars per ounce. And with gold prices approaching $2,000 an ounce, all of these 14 projects suddenly have very compelling economics. And what we're trying to do within gold mining, and I've joined the advisory board, is pivot away from just inventorying these ounces to de-risking these development stage assets by bringing them through an organized and systematic staging and studying of each of these projects, bringing it through the feasibility stage, so we can make as strong an economic case as possible, not only to the market, but also to potential joint venture partners and producers that will be looking for these types of pipeline projects to supplement their declining production and reserves. And to that end, I'm helping to build out the team at gold mining to help advance those projects. More recently, we hired a gentleman named Alistair Still, Alistair worked with me at Gold Corp. He ran our operations in Ontario, and then built our project in Argentina, and then joined me in the Vancouver office with our corporate development activities. And so he's quite savvy in terms of mine development, mine operation, but also understands the capital markets quite well. His job is to build out the team to de-risk these projects and re-rate them in the market as we demonstrate the compelling economics they have. And in addition to this, Amir and I have joined forces to create royalties on each of these 14 development stage projects and put them into a separate company called Gold Royalty Corp. And Gold Royalty Corp is currently 100% owned by Gold Mining, but the idea is to spin this out to a separate public company and use it to start to buy royalties in the gold space. And so within the gold industry, there's the producers, these explorers, and then there's the royalty companies. And the royalty companies effectively act as a bank for the gold mining companies that are looking to build projects, because they can access capital much more cheaply in the equity markets than the producers can. And by doing that, they can then deploy that capital in exchange for royalties into the gold developers and the producers. And we'll be able to daylight value by taking this public for gold mining shareholders. So the way to look at it is, if you're buying GLDG, which is gold mining on the New York Stock Exchange, you're getting this gold royalty company for free, and will likely crystallize a lot of value in a short period of time as we take this public for gold mining shareholders. So that value accrues to gold mining shareholders, and then we create a separate public vehicle for people that want to participate on the royalty side.
So you're really getting two companies for one.
Exactly.
And as far as gold royalty splitting out, I mean, that's going to happen this year, next year. Are you guys working on that right now?
We're working on it right now, and we've created a separate management team. I've hired a head of corporate development for Gold Royalty, a gentleman named John Griffith. John was with Bank of America Merrill Lynch, where he was the head of mining banking, their investment banking. I spent 25 years in the investment banking side with all the bulge bracket firms in the U.S. So he brings a wealth of experience and a tremendous network that we can leverage to grow this company out. And also, we created a separate board, and on that board, we've added Warren Gilman. Warren runs Li Ka-shing's money out of Hong Kong. He's a former Canadian investment banker. He's been based in Asia for about 25 years, and so brings a wealth of experience there in terms of investing in mining companies. And then we've created an advisory board within Gold Royalty, and that advisory board will be chaired by Ian Telfer. Ian was my chairman at Gold Corp, but he created the streaming business by spinning out Wheaton Precious Metals from Gold Corp about 15 years ago. So he's the father of Gold Royalty and streaming. He created that model, and he's going to help us replicate that within Gold Royalty. So we've accumulated a lot of very high caliber talent with strong networks and a long history in the mining business. And so management depth, I think, is critical to the success of these types of vehicles. It helps us access capital more cheaply. And it also helps us to access royalty opportunities that we can buy to help supplement the portfolio, a very strong portfolio we've inherited from gold mining, again, by writing royalties on each of these 14 development stage assets.
Yeah, I was looking at the management team, and Wheaton came up, and Ignacio Eagle, all of these just powerhouse companies that either you have been associated with and these guys have been associated with, and they're coming over to Gold Royalty with you. Is that correct?
That's right. Yeah, they've all joined the team. And so now our focus right now is to take this public in some form over the next few months. We're working through the mechanics of doing that. And so it'll be coming soon. And we've announced our intentions to do that by creating this Gold Royalty vehicle and putting it into a separate company that currently, as I said, 100% owned by Gold Mining, but it will be spun out as an independent public company in its own right. And the benefits of doing that will accrue to gold mining shareholders. That's why I say, when you're buying gold mining stock, you're going to get the benefit of that and getting 2 for 1, as you correctly pointed out.
Yeah, and if you would, why do precious metal royalty companies trade at such a premium to the miners, significantly higher price to earnings multiples? I mean, what is behind the love affair between investors and royalty streaming companies? What's going on there?
No, it's an excellent question. Look, mining companies, they take on all the operating risks. They have to build the mines, and so they can experience capital cost inflation. They can experience geological risk, operating risks, operating cost inflation. Royalty companies just take top line exposure. In other words, they get a percentage of the revenue, and they don't take any of the operating costs or capital cost risk. So they lend money into these mining companies and take a royalty back in exchange for the money they put into the mining companies to help develop their mines. So they get full leverage to the gold price. So if the gold price goes up, then they get the full benefit from it, but they don't take any operating cost risk. So if there's operating cost inflation, that doesn't affect the top line. The other benefit they get, of course, is if there's exploration success around these projects. In other words, if they extend mine lives, if they find more ounces in the ground, then the royalty companies get the full benefit of that as well, because the royalty is over the entire property and not on just the mine at the day that they make that initial investment and get the royalty in return. So they get full leverage to the gold price and full leverage to the exploration upside without any of the underlying risk associated with the operations. So that's why they tend to get a premium multiple, because they tend to have a much lower risk profile with all that leverage opportunity as well.
So it's kind of like it's similar to like the GLD or like the Sprott PHSY or PHYS accounts, where they're tied to what's happening in the gold market, but what the royalty company is doing is tied directly to the success of the mining companies as they produce more, which we can all see, the whole world can see.
Yeah.
Then there's that reflection, and Wheaton, that's been a model that it really sets the standard. I mean, that was the first company of that sort, wasn't it, David or Dave?
Yeah, it was, and Ian Telfer created it. He was running Gold Corp at the time, and he had this brilliant idea of taking royalties on his existing portfolio of mines and putting it into a separate vehicle. So effectively, we're replicating what he did 15 years ago, and so it only makes sense that we would have him on board. He's created the model. And, and the biggest royalty company in the world, Franco-Nevada, came out of Newmont under a similar structure. They were spun up by Newmont around 10 years ago now. And it was, again, by taking royalties on a number of Newmont's assets, creating a separate vehicle and then spinning it out to its own public entity in its own right. And so this is a model that's it's not new. It's one that the market understands. And it's the one that the market accords a much higher multiple than it does to the underlying mining companies that actually write the royalties on their own properties.
So, yeah, this is a tried and true method that what you guys are doing, and with the people that you have in charge of it are not only familiar with it, they actually built it. I mean, that
exactly right.
That's brilliant. I mean, that's incredible.
Yeah, and the other thing I've noticed over the last year or so is there's been a proliferation of new royalty companies, but they haven't done that. They haven't created themselves with the benefit of having that kind of mining sponsorship, senior mining company sponsorship that we're going to be enjoying from gold mining. So there's likely to be a reckoning within that sector as well. I expect there's going to be some consolidation among the streaming royalty companies over the next year or two, just because there's so many of them out there, but they don't have the benefit of that significant mineral endowment that we enjoy. Underlying our royalty portfolio coming out of the gate is this 25 million ounce resource across 14 properties. So we already have a well-diversified portfolio of royalties across 14 projects in the Americas in low political risk jurisdictions. And we have this sponsorship that we're enjoying from gold mining to get us launching off the ground.
Yeah, and I want to bring this back up here real quick because it's quite impressive. And this is the listing of projects that are associated with gold royalty. I mean,
Yep.
right? I mean, this is what I pulled this from the website, and you guys are getting after it.
Yeah, so as I said, it's 14 projects. It's diversified. There are very large projects here. There are medium-sized, small ones. And so what that tells you is that we'll be able to attract capital from producers of various sizes into these projects. You know, Alistair Stow's job as head of corporate development for gold mining is to bring these through the study phases in order to attract that interest from the producers that are starved for reserves and production. And by earning in and joint venturing these projects, we get capital into the ground to de-risk these projects and get them re-rated in the marketplace. As I said, you know, our ounces in the ground are trading at about $14 to $15 an ounce, but as we de-risk them, they could be trading at many multiples of that. And that's the opportunity that we're presenting to gold mining shareholders, in addition to spinning out this royalty vehicle, which will accrue benefits to gold mining shareholders as well. So we have a very coordinated game plan, both in terms of de-risking the underlying projects, but also daylighting value through the royalty vehicle. So there's a couple of opportunities here to accrue significant value to gold mining shareholders.
And I wanted just to kind of wrap things up. I mean, you mentioned something about the consolidation of the royalty and the streaming model, because quite frankly, I mean, these are not your words, these are my words, that they didn't replicate what your team has already built and knows is successful. And those companies, from, once again, my words, not yours, that I don't think that they're not going to have the stability that you bring to the table. I just don't see that, because they're not born from a mining company. They're born outside of that, and they don't have that sponsorship, like you said. And one of the things that I wanted to kind of to look at in a little different, take that same idea, that consolidation. This is what really fueled the fire for me when I explained to you a moment ago that I had forecast back in 2017, the end of 2017, that what's happening right now. And that was based on the fact that the mining industry itself was in serious trouble at that time. There wasn't any capital inflows, and that's what created the merger. And if I'm wrong, Dave, please correct me. But from my perspective, that's what created the merger between Goldcorp and Newmont, was the fact that there weren't any inflows, there wasn't any research and development, there weren't any new mines coming online, and now we're starting to see more capital inflows. We're starting to see the need for these top tier mining companies. And so they're going to start reaching out and buying up some of these junior mines that are in development. And that's what I think is really going to fuel everything. Or am I wrong?
No, you've hit the nail on the head. If you're not finding it, you're going to have to buy it.
Right.
And that's what happened. You know, that's what drove Newmont and Goldcorp together. That's what drove Barrick and Randgold together as well, to create the two biggest mining companies in the world. And that happened within months of each other. And so at the top, we've seen the seniors consolidate, probably to a sufficient scale. And now it's going to be the smaller producers that are going to have to start to buy these development stage opportunities to supplement their portfolio, because they haven't been finding it through their exploration efforts. And so we're positioned to expect that wall of capital to come in. The producers are going to start to put money into the development stage assets and refine that lost art of building mines. And the capital markets are going to have to follow. If the established producers start buying these development stage assets, then you know what? The institutional investors are going to start to buy these development stage companies. And so it's not a coincidence that at this stage in my career, I'm focusing more on the development end of the spectrum in the gold industry, because I think that's where the capital is going to have to flow, given the existential necessity for the producers to actually start buying development stage assets.
Exactly. And the institutional investors that are going to be coming in, we've already seen one pension fund come in and add gold to their portfolio. Do you foresee more pension funds and hedge funds of that type to add not digital gold, but physical gold like mining shares and actual physical gold, like the University of Texas, I believe it was a few years
Mhm.
ago, that Kyle Bass was involved in, and they bought $1 billion worth of gold, and the Texas bullion vault was built probably for that reason. But I mean, do you see? That's what I see coming online now, because there's nothing else out there to invest in. Or once again, if I'm wrong, tell me.
No, again, you're bang on. The advent of the gold ETF, GLD, almost 20 years ago, really opened up physical gold as an investable commodity for pension funds, for mutual funds, and the like. Before that, it was impossible for them to buy it because they had to buy a publicly trading instrument on a recognized exchange. But now we have that for the physical commodity, so it's much more investable for mainline or mainstream, I should say, institutional investors like the ones you mentioned. But what we're also seeing in the gold equities is value investors start to play it. Warren Buffett, for goodness sake, bought over $1 billion of gold equities recently. He called it a barbarous relic several years ago. It's not something he would have invested in under any circumstance. But as a value investor, he's got to be scratching his head about the valuations we're seeing in the general equity markets, which have been stretched beyond a recognition or any precedent, given the wall of paper that's been introduced into the system. The valuations have been stretched dramatically. And so he's not seeing value in the general equity markets, but he is seeing value in the gold equities because gold companies have done a tremendous job over the last 5 or 6 years of stabilizing their costs. In fact, seeing cost decreases with energy prices going down. We're an energy intensive business.
Yes.
And if oil prices are going down, our costs are coming down. Local currencies are weakening against the US dollar. So if you're mining gold in Canada, South Africa, Australia, in Latin America, you're seeing your local costs go down in US dollar terms. So your margins are expanding even with the gold price not moving up. With the gold price moving up, that's only amplifying it. So we're providing leverage to the gold price that we didn't, 10 years ago when costs were inflating. And Buffett's looking at that and saying, you know what? Gold equities are probably trading at $1,400 to $1,500 an ounce. That's what's discounted in the valuation. And gold is likely to be $2,000 to $3,000 an ounce. This is value now for institutional and general investors. And they're
Yes.
seeing this in this sector. They're not seeing it anywhere else in technology and finance, autos. There's nothing else that provides that kind of leverage and also value that they're certainly not enjoying in the general equity markets right now.
Yeah, and gold royalty would benefit in a just unbelievable way in light of what you just described. I mean, when these guys start moving and that really large money, the Warren Buffett type money, starts moving around, and people they pay attention to what he's doing, period, and they move in that direction.
Yeah, he's a
He and Ray Dalio and Kyle Bass. I mean, all these big name investors, people respond to what they're doing, and that's so. What you and your team are doing right now, my goodness.
Yeah, no, like I said, we're positioning ourselves for what the market needs. The gold market needs development stage assets. They need exploration success. Typically takes 10 to 15 years from discovery hole going down to the first production. So even if there was a major discovery tomorrow, you wouldn't see the benefit of that in mine production for a long, long time. But we're uniquely positioned in gold mining with quite mature development stage assets. We just have to put studies around and demonstrate the economic potential at these gold prices. And we're going to start to see a wall of capital come into these projects as producers recognize that they need to replace what they're depleting.
Man, I tell you, it's in full disclosure, I'm probably going to be investing in gold mining within the next 30 days. And that's something that I just do not do, to be perfectly honest, Dave. I just don't do it. So I need to have that on record out there, because what you where you're at and the team that you've surrounded yourself with is just, it's world class. And it's something that my audience is looking to protect their family. That's why they have physical metals in their portfolio, and that's how you do it. This is how you do it: is that you find companies like gold mining and gold royalty, and you get in early and you watch what's happening. Everybody out there that's been following my work for any length of time should know that this is a rare opportunity to get in. And it's not financial advice. I'm just telling you what I'm seeing and what I'm doing. This is for me. And people listening, you do with your money what you want. That's your business. And if you want to find out more, please go to goldmining.com, and you can find out all about it. And there you can invest in gold mining on the New York Stock Exchange under the symbol GLDG. And we've been speaking with David Garoflo, who is the CEO of Gold Royalty, soon to be making a major announcement, I presume, and of splitting out from gold mining. And Dave, this has been just an absolute pleasure speaking with you. I'm so grateful that you've taken the time to spend a few minutes with me and my audience, and I really appreciate all that you're doing. I think that it's tremendous, and I'm very thankful, and I hope that we can get caught up on what you're doing in just a few months and see where you're at.
Well, pleasure's all mine, Rory. Thanks for having me on.
And we will talk with you soon.